Where do I invest my money today? There's a lot of tactical advice that's thrown out everywhere today. Social media platforms, books, newsletters, articles, everywhere trying to tell people where they need to put their investment dollars. And tactics only work if you have a real plan put together and have an understanding of what a tactic is going to do for you. Otherwise, tactics are just playing a casino, in my opinion. You hit some, you lose some. Typically, the house usually wins, and so you end up further down the road in a loss provision than you would if you would have just stayed a steady state of doing something on a regular basis that you understand. The closer you are to the investments that you make, traditionally, typically, the less risk there is and the higher return. But let's talk about that because there are trade-offs on both sides. You've heard it over and over again. The best investment is the investment you make in yourself. And I would definitely reiterate that over and over again. The education, the formal education that you receive or that you invest in over your lifespan to gain some technical skills, some licensure, whatever it is, to put yourself out in the world, to provide solutions, create products, be a part of something. So you trade time for dollars, and that's the first level. But we have to invest in ourselves first. There are so many other ways to invest in oneself beyond the formal academic aspect, and that's where I probably found my greatest inflection points in life, is being a part of other groups or receiving coaching or mentorship from other people who have gone down a path that I would like to go down. And it doesn't just mean because of a certain lifestyle. It also means about the beliefs the person has and the core values. There has to be some congruency there for me before I'll just totally invest in what someone else is trying to teach. It doesn't have to be everything that fits what I want, but I look for as much alignment as possible. Being a part of groups or mentorship like that has been nothing but exponential to my personal freedom in my life. Yes, does it add to the net worth? Does it add to the capital one has to the potential lifestyle? Yes, it's all part of that. But that's only a small piece. What I really want in my life, and what I believe you want too, is more autonomy and freedom and discretionary time. Time is what we really want in life, and we trade a lot of things to try to get that time, many times focusing on the wrong thing. Focusing on the wrong thing that ends up taking more of our time, and we end up living a life of regrets down the road because we didn't enjoy the journey. We thought there was going to be a quick way to make the quick buck, make the quick profit on something, and in doing so, we don't really learn anything. Even if we're successful in timing a marketplace right, timing an exit right, that is not sustainable and doesn't provide any confidence or really experience that you can take on, extrapolate down the road. So there's a problem even with quick wins. And nothing against quick wins, but what else do you do with that? So investing in yourself, if you have no other place to invest, that's the first place to go. And again, many realms of that type of investment, not just the academic side that most of us have gone through to an extent. Next would be the capital that you have investing into something that you have your hands on, your own business. Now, look, when I was young, I had my own lawn mowing business. I had my own newspaper route business, if you want to call it that. Yeah, I was a one-man show, but the capital I put into having the right bike, the right baskets for the papers, the right lawnmower, and being responsible for taking care of the lawn mowing equipment, making sure that it was serviced and had oil in it, and the basics of a business. But I was on the forefront of driving that business. I made my own hours. I decided how many customers I wanted. I decided what price I would charge, at least according to what the market would allow for. I made my way. I sold greeting cards door to door. Many things I did as a young person, you had the same experience to some extent. I know you did. Whatever you did, but that's trading time for dollars. But it's a great place to start. So I do that for a point. My skill level enhances. I create maybe a business or a practice that has more moving parts, more scalability, and therefore more profit, and my lifestyle enhances. But I'm still on the forefront of having to drive the investment, the equity piece in that. Nothing wrong with that. It's just a matter of how long do you want to do that? How quickly can you escape what I call the hamster wheel of driving your capital by being in the business producing? When can you escape from that to some degree over time and start to enjoy some of the fruits of your labor without guilt, without feeling like you're giving up too much? It's a mindset. It's just a mindset 100% that most people can't absorb until they've been in environments of other people who have actually done it. And then you give yourself permission so you don't feel like you have the guilt about doing it differently than your peer group, your colleagues. I had to go through the same thing when I pulled the plug on my clinical practice career in dentistry when my daughter was very sick. I had constructed a plan B by investing in myself, investing in other assets outside the practice, and it allowed me to make that move. I had no guilt, no remorse, and it forever changed my life. Today, I get to do the same thing to help other practitioners with the same change of beliefs and mindset and the same understanding of where they can invest their capital. Yes, always with themselves first. That's part of a coaching program. That's part of being part of a group, is reinvesting in yourself. It's a reinvestment stage to do that. And then learning how to better optimize one's primary business, a practice, so that you have more free time while you're in that journey. And then on the exit, when you exit from that, do you have enough capital to invest in the right investments that, again, you have some proximity to what those investments are doing? Proximity means how much separation you have from that money. If I put my money in a stock portfolio or a mutual fund or annuity, I don't have really any proximity at all. I'm not saying there's anything wrong with having some allocations in the markets. Nothing wrong with it. But you don't really have control. You're riding the market. When the market goes up, everything's good. When the market goes down, not so good. So some allocations there, fine. What else? Other investments in what I call tangible assets, hard assets, your business, to the extent you're invested in a business, or maybe you're a passive, more silent investor, partner in a business. That's fine. That's great. More passive than active, and you got your hands on it, or to some degree, because you're a partner in it. What if I don't want to be a partner in a business anymore? What if I don't want to manage tenants or contractors or deal with issues of real estate, which was very kind to me? Well, I say kind to me. I did the work, so kind means it comes along with the effort I put into it. But I built an entire portfolio that turned into a net worth that let me buy back more time when I wanted to. And today, I don't want to do that part anymore. I'd rather be more passive. So I'm going to be more separated from my capital to do that. There's a trade. I don't get the same returns because my returns on my earlier efforts, going all the way back to the days when I was mowing lawns or throwing newspapers, or managing, acquiring, and creating the financing for the real estate properties I built up over the years, very hands-on. And my returns were very good because my time was invested in it. Today, don't want to do that. So I will take a lesser return on my capital if I don't have to put the same amount of time into it. Now I've got to invest through other people. I've got to vet them. I've got to put guardrails in place. These are all things that you can do, but you have to learn how to make this happen. One thing I'll tell you for sure is the more capital that you have to invest, the harder it is to make those investments, and particularly to achieve the higher returns on capital that one might want. Back in the days when I was operating and acquiring and building my real estate portfolio, I typically had returns in the high 20s and 30%. When you account for everything, when you accounted for appreciation, amortization of debt, the value add that I put into the properties, the tax benefits, all those things together, yes, my returns were well into the high 20s and 30%, no question about it. But if I'm not going to be involved in it, in the machinations, then I'm going to take a lesser return. Well, I'm fine with that. Once you get to a point where you have enough capital that's working for you in good places that are risk mitigated, you don't have to push the lever so hard anymore. That's the benefit of being a good steward of your capital. But it still takes some discipline not to be caught up in the FOMO that's out there today that still says to you, hey, you can still get these high returns over here, over here, over here. I'm not going to point anything out. I'm just saying it's everywhere today. And we're at a point in the market cycle where the great gains of yesteryear, I'm talking about going back 3, 4, 5, 6, 7, 8, 9, 10, a dozen years coming out of the GFC, Great Financial Crisis, those big returns are going to be greatly muted. Those that are promising those same great returns that many of us experienced are going into a higher risk profile to try to achieve those returns. To do that, you've got to use leverage, financial leverage in a time when interest rates are propensibly higher than they've been in at least the last 15 years. That's a time when you've got to take some chips off the table and go to a lower point on what I call the risk curve. The risk curve is an allocation we use in Freedom Founders to determine where we might want to allocate certain parts of our capital. Not saying that not putting some of the capital into a place where you can potentially get higher returns, but maybe not so much today as I would have put in 3, 4, 5, 6, half a dozen years ago. Taking a lower stake to preserve capital so that when the time is right and I can evaluate and have access to the right opportunities, I can go back into the equity play, the growth play, the one that we always like, that during growth periods in the market cycle gives us great returns. Those that are trying to sell you on returns of yesterday, I'm just saying be very cautious. Be extremely cautious. You better have a much deeper understanding of what those models are than you did before, when you could blindly almost invest in anything as long as the operator was not a scammer and come out with some at least decent, if not very good returns. The time has changed. The model's changed. We're in a different season right now. Discipline and patience is the key to get through these seasons and come out on the other side where you can still ride up the next market cycle. Being involved in a group that has their finger on the pulse of the market, discerning where to put capital, iron sharpens iron, that, in my opinion, is the best place for people who want to take their capital, shepherd it, and steward it forward in times that we have today that are quite volatile and quite uncertain. You can still make it happen, but you've got to be on the forefront. You cannot abdicate to old models. The old models, in my opinion, are not there. They are broken. I hope this is helpful to you.